March was a month of mixed fortunes for the Harmony funds. The Euro Diversified Fund delivered the best return, gaining 1.4% in Euro terms. The Sterling portfolios also performed well with gains of 0.8% and 0.6% for the Balanced and Growth funds respectively. The Australian Dollar Growth Fund posted a marginal decline of 0.3%, while the US and Asian portfolios proved the laggard with declines of around 1 to 1.5%. With the first quarter of 2015 behind us, it was good to see all the funds were up over that period, ranging from marginal gains in the US dollar portfolios to very strong gains of around 11% and 7% for the Euro and Australian portfolios respectively. Meanwhile, the Sterling portfolios gained between 4 to 5%, while the Asian portfolios gained around 2%. Market returns showed fairly wide variation across different asset classes and geographies over the month. For instance, European equities performed strongly, up over 3% in local currency terms, but Asian and Australian markets posted small declines, while the US and UK markets fell by 1.5 to 2%. Meanwhile, bond markets saw modest gains across most regions for sovereign bonds and investment-grade credit, but lower-rated high-yield bonds in the US struggled and delivered a small decline over the month. Currencies had a significant bearing on the variation in returns across the Harmony funds. The US dollar gained around 4% versus both the Euro and Sterling, and around 2.6% versus the Australian dollar. The translation effect of this led to negative returns for most global equity and bond indices when expressed in US dollar terms. This was an important factor behind the weaker performance of the US and Asian Harmony funds during March, given the base reporting currency of those funds is US dollars. Overall, neither asset allocation nor manager selection had a significant bearing on performance over the month. However, notable contributors included our holdings in global and Asian convertible bonds, which gained 0.6% and 1.6% respectively in dollar terms. Also, our UK equity, global real estate and global infrastructure investments performed well on a relative basis. The worst performing holding was the Copernic Global Equity Fund, although its small position size meant that it did not have a large impact overall. The manager's deep value style continues to struggle in the current environment. However, underlying valuations are very attractive, so we marginally increased the position size recently across all of the funds. The only significant change was within the property component of the portfolios. Across all Harmony funds, we have switched our listed global real estate manager from Cohen & Steers to Third Avenue at a 6% weighting. Both managers invest in real estate investment trusts, known as REITs, and other real estate related securities, which provide exposure to commercial and residential property. These securities offer the diversification benefit and long-term return potential of real estate, but with the liquidity of an equity security. After conducting a detailed research review into the sector, reviewing and meeting dozens of managers, we concluded that Third Avenue is the standout manager globally for a number of reasons. They've been managing this strategy for over 15 years with the same lead manager throughout, Michael Winner, who is now supported by 2 portfolio managers with extensive real estate investment experience, as well as 3 analysts. They've always implemented the same value-oriented approach that all Third Avenue funds are consistently managed according to. They manage around $4 billion in the strategy, but are committed to closing to new investors at a sensible level, which will help them to continue to generate outperformance in the future. And this capacity awareness is particularly valuable, given that, unlike the manager they're replacing, Third Avenue's portfolio is relatively concentrated and looks nothing like the benchmark. This flexibility they benefit from means they don't have to have a high allocation to REITs, which at the moment we consider to be relatively expensive now, driven by the market's search for yield and income. Instead, they invest substantially in real estate operating companies, which are often cheaper and have higher growth rates as a result of not needing to pay out all their cash flow as dividends. This very much speaks to the absolute return-oriented approach that Third Avenue invests with. These are some of the key factors that gave us confidence that this fund can deliver strong returns and outperformance over the long run.